Yeah. So in the previous session, we started with the concept of investment. We discussed what is the meaning of investment. It's nothing but sacrificing today's value for future expected cash flows. Then we discuss how we can arrive with saving income minus expenses. Then we discuss what is our dependent and independent variable with certain equation we form. So we discuss that investment is a function of savings and investment can be also the function of income, and we discuss one more concept, equation number 3, that investment can be the function of rate of interest. Then we discuss what is price concept. Price is what you pay to buy or sell the assets in the market. So two types of price, one is market price and one is market value. It can be also referred as market price and market value. Then we discuss what is return. Returns, it's nothing but the amount of money you make from your investment, which is expressed in percentage. Then we discuss what is risk. It's nothing but general consensus that what is the likelihood of losing the money, it's nothing but risk. Then we arrived with different formulas and different concept with related to example of expected return and risk. So we discussed three example, and then we came with very important relationship that safer assets are worth more than riskier asset, and we derive the relationship from this that the value of any asset increases as the risk decreases, and we also can say vice versa, the value of asset decreases as the risk increases. Then we discuss one relationship among expected return versus price. As the risk increases, expected return also increases and price decreases. As the risk decreases, expected return decreases and price increases. Then we discuss the formulas on how to calculate stock returns without dividend and with dividend concept, right? So now today we'll continue with the methods what we were deriving yesterday. There were basically three methods where we were discussing on how to calculate the expected return. The first one was historic average returns, and the second one we discussed about the state contingent probability method. That is one of the method for calculation of expected returns, and we discuss both the formulas. Now we'll come up with the next third one we'll discuss over here. That is nothing but your asset pricing model. So let us start with discussion on this concept. So we'll write it as third concept, asset pricing model. Is it visible what I'm writing on the screen?
Yes.
Okay, sir. Yes. So now what is basically this asset pricing model? What is the concept of this asset pricing model that we are going to discuss in today's session? That's a third method for calculating expected return. When we talk about asset pricing model, this model particularly uses two fundamental approaches, or we can say two tools to derive with expected return. It used the concept of some mathematical concepts, and it used some concept of logic. Okay. So maths and logic are the tools that is used under this method to calculate the expected returns. Okay. Now, fundamentally, what asset pricing model says, what is asset pricing model says, this model is purely rely on at fundamental level. These models, it's fundamentally level, they rely on three things. The first one is linearity. The second one is called perfect information. Perfect information. And the third one is efficient market. So this is the fundamental, at a fundamental level, this concept is based on three levels we call as linearity, perfect information, and efficient market. Now, when we let us discuss this concept of linearity, perfect information, and efficient market here. When we say linearity, okay, now linearity is nothing but equation of straight line. It's a concept of equation of straight line. Now, how do we write the linearity of straight line equation? We say y is nothing but alpha plus beta into x, right? So now this is a linearity concept. We say regression concept also. So here y is one variable, another one is x. So y is dependent and alpha is your intercept value. We saying when the value of y, it's unknown value of y, when your x is 0, that's your alpha value, and beta is a coefficient value, and x is your independent variable and y is your dependent variable, right? So beta is also called as slope here. It's nothing but impact on y when x changes. Second one is concept of perfect information. Okay, now what is perfect information here? The model assumes that in perfect information all the investors have same information. That is called perfect information. All the investors have same information and everyone has right information. We can say all the investor has same information, and we can say all investor also has right information. That is your perfect information. That's the second fundamental level of asset pricing model. The first fundamental level is linearity of straight line. Second is perfect information. That's nothing but the model assumes that all the investors have some information, or we can say we have same information as well as right information. And the third one is efficient market. Third one is efficient market. Now, what is efficient market concept here? That very important. It's called efficient market hypothesis concept here. So under this efficient market, it is once again an assumption that assumes that markets are efficient. So in under this, we assume that markets are efficient. When I say market means I'm talking about stock market. Market is efficient so that all information, okay, in market, all informations are immediately reflected in the price. These informations are immediately reflected in price of any security. Security means I'm talking about stock here. So these three levels are nothing but the fundamental approach for asset pricing model here. Okay, am I making sense here?
Yes.
Uh, Others participant?
Yes, sir.
Okay. So what we are trying to tell, we are building asset APM model. It's also called as APM model. We we are telling that it's depend on two tools. It's calculated based on maths and logic. So what is fundamental level? Linearity, perfect information, and efficient market. These are fundamental levels for asset pricing model. So what is linearity? It's a concept of straight line. We use the linear regression model. We call it as y is equal to alpha plus beta into x. Second is perfect information. We assume that it's a once again assumption. all the investor have same information and right information. And third one, it says efficient market. In efficient market, once again, it's an assumption that all the information is immediately reflected in price of any securities. Okay. So again, there are different school of thoughts are there. We can say, let me. This is once again for just for information for all of us. In finance, you try to understand what is the school of thoughts here. Okay, there are two school of thoughts we can say here. The people who believes this theory we call as efficient market theory. So we say efficient market hypothesis or efficient market theory, and there are some people who don't believe this. So we say they don't believe this concept of efficient market hypothesis. There are two school of thoughts. If the investor who believes that there is a market is efficient, it means they are considered as one group of finance. They believe in all this kind of market assumptions. All the investors are rational. They believe in that school of thoughts. So it means they believe in efficient market hypothesis also. But there are people who don't believe this concept. They don't believe that market is not efficient. So we say market is inefficient. So those people again they study different concept. That is where the concept of behavioral finance will come into the picture. Okay. So what is the two school of thoughts we are trying to tell here? We are trying to assume that the people who believes in efficient market hypothesis and who don't believe in efficient market hypothesis, the people who believes, that's one category of finance people who does the all the research based on the markets by considering this theory. But there are people who don't believe on this concept. That's different study where emerging nowadays something called as behavioral finance approach. Okay, this is just an for information what we can categorize the school of thoughts in finance. Okay, is it clear?
Yes.
Yeah. Shall we move to the concept of now further?
Sure.
Yeah. Yeah. Next one is now in asset pricing model, we'll discuss first one called generalized generalized asset pricing model. So we can write as generalized asset pricing model. Okay. Now what is the formula under generalized asset pricing model? We can say the expected return of RJT, okay, is nothing but alpha plus beta j ft plus epsilon t. Okay, this is generalized asset pricing model. So what is this formula? Let us try to understand. It's generalized asset pricing model. ERJT is nothing but expected return on a stock J at a time T. Expected return is nothing but alpha A for alpha here, beta J, beta of stock here, FT plus ET. Now what is FT? FT means here FT stands for factor. Okay, factor that impacts the expected return. Factor that impacts the expected return. Expected return, that is called FT plus ET. ET is epsilon term here, which is nothing but your some error term. This is your generalized asset pricing model formula. Now, with this generalized asset pricing model, we will discuss very important model, which is nothing but your CAPM model, right? Is it clear what we are trying to discuss here?
Yes.
So, what we are trying to tell here, it's a general asset pricing model formula. Expected return of a stock at a time is nothing but with alpha plus beta j of factor plus ET. Okay. Now let's discuss the concept of from this generalized equation model. We have model called as CAPM model. Okay. So before discussing CAPM, we should know what is generalized asset pricing model, because CAPM is also nothing but capital asset pricing model. So once we discuss generalized, we can go with the next called as capitalized asset pricing model. Now, what's this concept of CAPM? Will discuss here. What this CAPM says, okay, it works on the premises that return, okay, the return of any asset, return of any asset. When I say asset means financial asset like stock, is based exclusively on, it is exclusively based exclusively on the assets relationship with market. Okay, or we can say stock returns, a stock returns that impacts, the only things that impact the stock returns is because of market portfolio. Okay, in simple language, a stock returns get impacts because due to what? Market portfolio. Fundamental is clear here. What we are trying to say, what CAPM says, any asset will have a relationship with the market, right? So it means your asset returns are depend on the market returns. So your asset is your dependent variable, your market will be your independent variable. So any returns changes in the stocks is due to what? Market portfolio. Till now, is this concept is clear?
Yes.
Okay. Now let's discuss further. It's that what this CAPM does, it ignores everything else. CAPM only talks that a market returns is only because of stock. We can say stock return is because of market portfolio, or we can say market diversification. But CAPM ignores many factors which are not considered for calculating of stock returns. So it ignores what, like firms future prospect. That is, we can say, one of the limitation of this model. Then future prospects, or we can say firms cultures and values, or any other specific information, or any other specific information which, or we can say specific elements which is not considered for calculating the stock returns, because this is ultimately because it relies only on the CAPM, only relies only on the power of diversification. So it believes on the power of what? Diversification. That's where the stock returns get impacted. But many things which is not considered under the calculation of stock return is these elements which are ignored by the model, right? Now let's take the simplified proof of CAPM. Okay, how do we write this CAPM model? The expected return of any stock, ER, expected return of J, is nothing but alpha plus beta j. It's nothing but alpha plus beta j ft. So again, expected return is equal to alpha plus beta j ft plus et, right? Basically, what is this model? This is just now we discussed, right? Generalized asset pricing model, right? Generalized asset pricing model. This is what the equation we saw. So expected return of a stock is nothing but alpha plus beta and some factors plus epsilon t, right? So now we can rewrite this equation here. Expected return of a stock ER, okay, or expected return of J, a stock, minus RF is equal to alpha plus beta factor beta J, again expected return of RM, that is called market returns, minus RF plus epsilon T. Are you getting this equation? How I'm trying to derive the CAPM formula? Hello?
Yeah, once again, can you explain?
Uh, which one? The second line, sir?
Again, towards.
Yeah. So this is the first model. What was the formula of generalized asset pricing model? Expected return is nothing but alpha plus beta j ft plus et, right?
Correct.
Now, what we are taking here, the actual CAPM model, what it says here, capital asset pricing, further we are deriving simplified proof of this. Expected return, okay, minus your RF, that is your risk free factor, is nothing but is equal to, it should be equal to alpha plus beta j, open the bracket, expected return on market minus RF plus your epsilon t. The same formula we further decomposed,
Mm.
right?
Okay.
Now what we are trying to do it from this formula, what our CPM says, just now we discuss here, CAPM model, what it says, trying to explains, market is the only factor which decides the stock returns, right? So
Yes.
it means it believes on the power of what? Diversification. But is it consider any other factor?
No, it ignores.
It does not consider any factor. What it considers CAPM, market is the one factor which decides the stock returns, right?
Correct.
Nothing but the power of what? Diversifying. So now we can simply further this formula can be rewritten like this. So what we are trying to say here, if we are telling that the assumption from this formula is, if the market, okay, is the only influencing factor on returns, if the market is the only influencing means that is impacting your influencing factor on stock returns, what we are trying to tell, expected return on market minus RF, that is called risk premium, that is the factor which deciding your market, nothing but your stock returns, right? So market is the one factor which influence the stock returns, right? So if only market is the factor, then in that case what it should be, this alpha should be equal to 0, and epsilon should be also equal to what? 0, right?
Correct.
Is this concept is clear? Other participant? Hello? Am I audible?
Yeah, you're audible.
What exactly the formula says of CAPM? Expected return on stock minus RF is nothing but alpha plus beta j into expected return of market minus RF plus ET, right? This is once again a linearity concept came here. So what we are trying to tell, the assumption says that market is the only factor which decides the stock return. Then in that case, your alpha and your epsilon, that's error term, should be equal to how much? 0. Then can we rewrite this formula once again? Then in that case, we can say the expected return of a stock minus RF is equal to, right? Then what is left? If alpha is 0, then what is left now? Beta j
Yeah.
bracket
Expected
expected return on what?
market.
RM minus RF, right?
Correct.
Is this formula is making sense now?
Uh,
So what is the formula for now CAPM now then? So what CAPM says, expected return of a stock J is nothing but what? RF plus beta bracket open, expected return on RM minus RF. Now is it clear this formula how it came?
yes.
Now earlier this RF was minus, right? So what we taken from left side it became to the right side, then minus will turn into what?
Plus.
Plus, then it will become RF plus beta bracket expected return on RM minus RF. This is how the CAPM model we can write as per the formula. Right now, what is RF here? RF stands for
Yes.
risk free rate. So it's nothing but whatever the yield we get on yield of, we can say T bills or treasury bonds, government securities, that rate will be taken as which rate? Your risk free rate. Now, what is the next factor here? What is the next one? RF plus BJ. We can say B means what here?
Beta
Beta.
coefficient.
It's a beta coefficient. Now, we know all in finance there are two types of risk, right? Systematic and unsystematic risk, correct?
Yes.
So, beta follows here which risk? It's a
System.
systematic risk. Now, what is basically systematic risk? It is uncontrollable, right?
Okay.
The risk which cannot be controllable is called which risk?
Systematic.
Systematic risk. And there are many risks which are uncontrollable in the market. We can say uncontrollable risks. What are those? First is market risk. Then market risk is controllable or uncontrollable?
Not controllable.
It's not controllable. So we can say uncontrollable risk. Then interest rate risk. Once again, that is also uncontrollable. Then purchasing power risk. So all these things are which considerable as which risk?
Systematic.
Systematic risk, or we can say those are uncontrollable risks, right? Are you able to understand everyone? Hello?
Yeah.
Yes, sir.
Okay, sir. Okay, okay.
Yeah. So we derived with that concept of how exactly we can use this particular model of, we can say, CAPM model. And we have particularly calculation for that also we can take with the help of our RF plus beta of stock. When we discuss this concept of risk, we'll discuss that particularly how exactly we can calculate the beta, that we'll discuss in our Excel sheet. Okay. So but there is another thing which we can, this was the last model we can say to calculate your expected return of a stock. Till now, we discussed the concept of all the returns. How do we calculate, right? But there are many limitations in this also. We can say your market risk, and there is something called as your historical returns. It has all limitations, but CAPM also has one limitation. Because of that, there are one theory has come into the picture called as, because CAPM says that the market portfolio will decide the stock return, but this theory is been later on again evolved with new theory called as arbitrage pricing theory. Okay, these are recent theory which has come into the market. So what this arbitrage theory, AP model, we say asset pricing model. So this is the we can say theory which has overcome the factors what CAPM has not considered while developing the formula. So, what arbitrage pricing theory says, there are multiple factors. Okay, there are multiple factors which decides the stock returns. Not only market will decide the stock returns. There are multiple factors decides the stock returns, and that is where we have some theories behind this one. We called as there are many people who has come across with this theory. So there is a formula for arbitrage pricing model is nothing but your expected return of any stock is nothing but RF plus it's beta 1 F1 beta 1 F1. F1 means factor 1 plus beta 2 F2, that is called factor 2, and it is many factors which can decide the stock return. It's not only the market portfolio will decide the stock return, plus beta n, right, factor n. So this is your arbitrage pricing model theory. Classical example, there are many which we use this particular concept of arbitrage pricing model. One very famous research has been done by Pharma. We call it as Pharma French. Okay, in 1992, he was the person who developed three-factor model. Okay, and which talks about there are three factors which decide stocks return. Those factors are like, according to Pharma's three-factor model, we can say. So what he says that a stock return is impacted by three factors. The first factor is called your market portfolio. Okay, and the second factor what he says is the size of the firm. Okay, that even that also impacts the stock return. So size of the firm is nothing but whether it's a small size versus big size of the firm. That is what Pharma has told in his research paper in 1992. And third one is something called as the nature of the firm, right? This is also third factor which can decide nature of the firm is nothing but whether the firm is value firm or whether is the firm is growth firm, right? This is what Pharma has developed one factor we call which decides the expected return of a stock. So according to him, the formula is what Pharma has given. The formula for return is the expected return of a stock is nothing but RF plus beta 1, coefficient of 1. So first factor is market portfolio, so we can write as E, then bracket open, RM. RM is expected return on market minus your RF, close bracket, plus the second factor what Pharma has told is size of the firm. So we can say beta 2 SMB, SMB, that is nothing but small versus big size of firm, plus what he has told another third factor according to Pharma is your beta 3, and that is nothing but value firm versus growth firm. So he has written formula as HML, high growth or low growth firm, HML. So that is what Pharma has come across with this factor model. That's called three factor model. So it means market, or sorry, stock return is not only depend on market portfolio, it also depend on, according to Pharma, he says even the size of the firm matters and even the nature of the firm also matters. Is it clear?
What is that SMB? Small versus big?
Big, yeah, small firm versus big firm, that factors will take it here. Beta 2 coefficient
What
value.
M stand for here? Any specific?
What's that?
What is M stand for here?
High
Yes.
or medium low growth value. High,
No,
medium,
the
low growth value.
SMB. SMB.
SMB, small or medium or big size firm.
Okay. Small, medium, big. Okay. Okay.
So
Understood.
it's nothing but the size of the firm, whether it's a
Okay.
small, medium, or big like this. Is it clear?
Yeah.
There are many research papers actually which has been come across in this concept of these particular factors. Okay, pharma is there. Then there is a one person called as Carhart 1997. He also then pharma French again he came with five factors model. So this is where we calculate the stock return. These are the techniques to calculate the our stock returns. Is it clear?
Yeah.
Any doubts still here?
No.
Shall we proceed?
Yeah.
Okay. Let us try to understand. Next, we'll go on to the calculation of risk factor. Okay. Next, we'll discuss risk concept and risk and relationship concept. So, when we say risk, or we can say stock risk, we discussed, right? Risk is nothing but chances of losing the money. Now, all the stocks, okay, a stocks gets impacted with, okay, impacts by two types of risk. A stocks gets impacted by two types of risk. Now what are those two types of risk? The first one is called firm specific risk. Okay, the first type of risk is nothing but a stock can get impacted due to a firm specific risk, and the second one is something called your market risk. So it means we are discussing both the risk, nothing but firm specific risk and market risk, which can impact your stocks, or we can say which can impact your stock returns, right? Now what is basically a firm specific risk, that we'll discuss now. Firm specific risk. Now when we say firm specific risk, it's nothing but the risk which is associated with the business. right? So, for example, what can be firm specific risk? Let's take the CEO of, we have taken the data set of Facebook company. The CEO of Facebook is leaving the organization, right? Now, is it a firm risk or market risk? It is purely what type of risk we can say. The
Firm
CEO
risk.
of Facebook is leaving the organization. It's nothing but it's a firm specific risk, right?
Correct.
Is it correct?
Yes.
So, because of this news, there is a chances of impact on your stock. So we say the stock got impacted because of firm specific risks, because of some organizations factor that will hit the returns of the your stock. That's the first example, right? Suppose one more example which can be related to your firm specific risk can be, so let's say for example, uh, batteries of Tesla company are not accessible, right? So let's say for this particular Tesla companies, they are not able to access the batteries, right? Because they believe in e-vehicle concept, right? So they are not able to access so much of battery. So what will happen once again? Tesla stock will hit.
Yes.
Yes or no? So once again, this is related to the firm specific, right? Which can impact the stock returns of the Tesla company over here. Am I clear?
Yes.
Right. One last example we'll discuss of firm specific risk, right? Let's, for example, Netflix, okay, servers are in good conditions, or there is some problem with the servers of Netflix. What will happen? Because of this, the subscribers of Netflix may go down,
Yes.
and because of that, what will happen? The stock of that particular company will fall down, and due to this, there will be return also will be fall, right? So once again, what happened? This is with related to which risk now? This is firm
Yes.
specific risk. It's called as firm specific risk. Is it clear,
Yes.
everyone? Am I able to connect? What is firm specific risk?
Yes, sir.
Yeah. What about others? Natika ma'am.
Yes, sir. Yes, sir. Yes, sir. Clear.
Yes, sir. Yes, sir. Okay, sir.
Uh, am I going in speed? Just let me know so that we can go, and because concept should be clear. That's the reason I'm going slow a little bit.
It is perfect.
Perfect, sir.
Yes.
Okay. Now let's discuss next one. Now we have something called as total risk. Now what we can say, total risk nothing but total risk of a stock or total risk of a firm, right? So what is total risk? Is nothing but one is your market risk, right? Which is nothing but we have separate discussion on market risk, and one is something called as what, firm specific risk. So it means a total risk of any firm or the total risk of any stock is nothing but it's a combination of market risk plus specific risk, that is called firm specific risk. So that is how we measure the total risk of any companies, or we can say stock. Especially for stock we measure total risk like this, right?
Yes.
Now when we talk about risk, the risk is nothing but what, the volatility, right? The volatility of what, stock. And how we have to measure this volatility of the stock by taking the, that is through concept of what, standard As of now, we have one tool which measures the volatility of the stock, that is called as what? Standard deviation, right? So it means the volatility of the volatility is as equal to what? Risk of the stock, right? Volatility is nothing but risk only. And how do we measure the risk? Now we have a one tool called as what? Standard deviation, right? Now, when we talk about this volatility, or we can say the risk factor, now let's discuss what is volatility here. The volatility is nothing but what? Is equal to risk. So the volatility of the stock is equal to Rj, okay, minus E, open the bracket, Rj, bracket close. That's nothing but your volatility. Now what is Rj here? Rj is nothing but returns of the stock.
Actual returns of the stock.
Those are actual returns of the stock. Okay. What is the next one? E, open the bracket, Rj, we called this is nothing but what?
Expected.
Expected return of the stock. Expected return of the stock. So it means what we are trying to do, we are trying to understand the difference between, so return of the stock is called actual returns, and expected return is nothing but ER of the stock is called expected returns. So what we are trying to know, the difference between actual return, right? So let's say the difference between what? The actual returns and which return? Expected return. Expected return is called as what?
Deviation.
Deviations. Is it correct?
No.
So what is deviation here? Deviation is nothing but the difference between your actual return and expected return, right? Now, all of us, shall we do one lively, shall we see what is deviation in exactly in market?
Yeah.
Yeah, please open the Excel sheet of yesterday what we were doing. I think Facebook company, right? Please open that same data set. Please, all of you open the Excel sheet, right? Now, I hope you have this returns calculated yesterday, right?
Yeah.
Okay. Now, please write down next one. We have FB written. FB means Facebook returns, and there is something called ER, because this is called actual. And one more, what we need? ER. What is ER here? Expected return. So please write down there expected return. So as we discussed, there is no first day expect year returns. So let's say I'll take from the second, that is from C3 onwards. Now what was my expected return here? What is expected return on Facebook? We have right here. We calculated yesterday. How much is that? 0 point. So what is expected return according to this? It's nothing but average of all this, right? Is it this one expected return? Can you please calculate that one? Okay. Now my expected return will remain same. Yes or no?
Yes.
So my expected returns will remain same. So what I will do now, this value, okay, I'll drag it same value. I'll drag it there. So just copy this one. Okay. Now this is same for me. Now we'll plot a graph for this. Now let's see. I'll add few columns here. We'll take here Facebook return and expected return. Both together we'll try to plot. Select this two. Remember your expected return is same. Only actual returns are changing, right? Select this two. Go to insert and just plot this graph. Okay. Select this line chart here. Second one. Click OK. I hope you got this chart.
Yeah.
So now what is this chart title? Actual return versus which return?
Expected.
Expected return, right? So now let's see. So this is, I hope you got this graph like this.
Yes.
Now what we are trying to say, just now we were discussing the concept of the difference between actual return and expected return is called as what? It is your
Deviation.
deviation. So what is deviation here in our stock? The blue color, sorry, the orange color line expected return, and the g- blue color lines we can say sparks, right? Yes or no?
Yes.
That is for which return? Actual returns. Now just let me check zoom and we'll see here. Let's imagine this first stock here. This is your average line. Average means which return? Expected return. From this average to this line, the first line, first day of return. I think it's return first day is negative, right?
Hmm.
So between that line to this line, there is a gap.
Hmm.
Let me write here. We can see there is a gap here.
Correct.
Then second day also there is, if the returns are positive means the gap will come from year to year, this point to this point. So like this every day there is a gap between actual return and expected return.
Correct.
Look at this one. This is one point and this is your expected return. So there is a deviation is there or not? How much is the
Yes.
deviation? This is your deviation. Let's take this point. This is one point. This is another point. This is called deviation, right? So whichever high sparks are there, I'm trying to highlight so that it is visible. From year to year, there is a deviation. Am I clear?
Yes.
So deviations are, your deviation can be plus or it can be what? Minus. Yes or no?
Yes.
So what we are going to do? The data is having almost more than 1,000 observation, correct?
Hmm.
So can we take this more than 1,000 days? can we take day 1, day 2, day 3 till it will be till 1000? So each day deviation, can I take it and take it sum of this? Yes or no?
Yeah.
Can I take sum of every day's deviation? It means from first day till 1000. Then what will become? This will become sum of what? Deviation. Am I clear what I'm trying to say? Let me come to this Excel sheet. Okay. Now, what is the next concept? We define deviation. So deviation is nothing but deviation from which value? Mean. So mean is nothing but your expectations, right? So the next concept comes here, the sum of deviation, right? What is sum of deviation? Adding each deviation for all observations, right? Then if we add, I told you this, the deviation can be what? Plus, or the deviation can be what? Minus, right?
Yeah.
It can be plus or it can be, I'll write it, add, it can be plus or it can be minus. Now, when we take the sum of deviation, it should be how much then? It
Zero.
should be equal to 0, right? All plus, all minus, all plus, plus minus, plus minus. Then sum of all deviation will become how much?
Zero.
0. So it means, let me write here. I'll come to this one. Let's discuss here. What we are trying to tell, summation of, okay, n of time is equal to 1. Okay. So what we are trying to say, Rj minus expected return of Rj will equal to how much?
Zero.
0. So it means it is nothing but SSD, sum of deviation. It's called sum of deviation will equal to 0. So actual return minus expected return will become 0, right? Now what we are trying to say, the risk cannot be 0. So we have to overcome this 0, right?
Correct.
So we have to overcome the zero sum by using called, now this 0, what we are trying to say, this 0 is somewhere, we can represent like something called as risk free kind of, or we can say zero risk. But we know any stock cannot have a zero risk. So what we are trying to do, this deviation, what we'll do, we will do square of this. Why we are doing square? To overcome the issue of what? Zero. Is it clear? So what we have to do now? We have to do square deviation. So what is square deviation? That is called sum of square deviation. So how to write now? Sum of square deviation is nothing but SSD is equal to summation of n, t is equal to 1. So what we'll do? The deviation is nothing but what? Rj minus what? Expected return on Rj need to what? Square.
Square.
Now, what is this square? The deviation we are doing square. That is why it is called sum of square deviation. Right? Now, why we need to do square? Why we need to do square for this? What is the reason of doing square of this deviation? Can anybody?
To avoid zero risk.
To avoid the zero. Okay. So it means,
To understand the volatility of that share.
to understand the volatility of the share. So it means, as you told correctly, sir, volatility is nothing but risk, right? And when we say volatility is as good as risk, now when we say risk, the risk should be always what? Positive, right? It should be in which number? The risk should be in positive. Means what? There is a deviation or there is a risk of that much percentage, right? So here all negative whatever value is there will square it, will automatically it will become plus, right?
Correct.
So it means the volatility, or we can say the risk, we can say square deviation ensure that volatility is always expressed as positive number, right? So the value of zero can be reasonably interpreted when we say zero, right? It's nothing but risk free. So finally, what we need to do, we have to penalize that deviation. So how are we going to penalize the deviation? By taking the what? Square of that deviation, and then when we take square of this deviation, it will become sum of square deviation, right?
Correct.
Now you see SSD, we got sum of square deviation, so it's nothing but actual return minus expected return. Whatever difference will come, we'll do square for that. Okay. Now you tell me, large deviation means what? The stock is treated as what?
Risky stock.
We can say that stock is very high risky,
Yes.
and deviation can not be always large. It can be what? Small deviation. If that deviation is small, means we can say this risk is what? We can say low risk stock, right? Now what we need to do now with this deviation, right? We get the concept of what? Variance. Now what we say variance, once we get deviation, we can calculate the variance of the stock. So variance of Rj is nothing but 1 divided by n minus 1 summation of n t is equal to 1 bracket open Rj minus expected return of Rj square. Yes or no? Is it clear this formula for variance now?
Yes, sir.
So what is variance of any stock? 1 divided by n minus 1 to the summation of actual return minus expected return squared, right? So this whole thing I can write as sigma j square. Can I write like this?
Mm.
What is sigma square here? It's nothing but variance of a stock. If I say, if I remove this sigma, then what will left? Only sigma j. Then what will become this one? Sigma j means what? It's a standard deviation of stock. Is it concept is clear? Anyone
Yes,
can
sir.
respond, please.
Yes, sir, clear.
Yeah. So tell me, what is the reason of? One second. I'll add. Okay. Now let's try to understand. In previous formula, what is the variance formula? Variance of a stock is 1 divided by n minus 1 summation of n t is equal to 1 rj minus expected return of square which is equal to variance of stock. Now there are some textbooks, there are some people who has authored some textbook, they don't take n minus 1, but there are some textbooks who take n minus 1. Now what is the meaning of this n minus 1?
Sir, the sample size, sir. The
the sa-
the variables have taken from the sample.
the variable has been taken from the sample, it means from population we'll take some samples, right?
Yes, yes, sir.
So what is the logic of doing that minus 1, right? Because try to understand 1 divided by n minus 1, this n minus 1 is nothing but total observation minus 1. It's called as unbiased estimator. Okay, this is your unbiased estimator, right? Unbiased estimator of true variance. When we do variance, no, we take n minus 1, right? So when we are doing this n minus 1 from the variance, it means what? We are trying to get closer to the population. Am I clear with the concept? What is this n minus 1?
Yes.
So first of all, what is the logic of doing this one? First we take n minus 1 is nothing but unbiased estimator of true variance. And one more thing is, because as our sample is close to population, when our sample is close to population is nothing but n minus 1, it's nothing but chances of accuracy will what? Increase. So whatever the result will come from the sample will actually will be close to the result of what?
Population.
Population only. Is it clear why we need to do that one? Yes or no?
Yes, sir. To get accurate result.
To get accurate result means nothing but we are trying to close to the population, right?
Yes,
Now
sir.
how do we write this? Now variance we got, right? What is variance of stock? Variance is this one, 1 divided by n minus 1 to the summation of rj minus expected return on rj square. Now variance, right? Variance is actually a volatility. Variance is actually your volatility, right? Now it's nothing but your risk only. Now what we are doing, from variance we can calculate what?
Standard deviation.
Standard deviation. So because square root of variance is nothing but your standard deviation, so what I will do now, let us calculate standard deviation. Let's see how to write the formula for standard deviation. So standard deviation is nothing but sigma j. Sigma j means sigma of a stock. It's nothing but root of 1 divided by n minus 1, right, to the summation of n to the time of rj minus expected return on rj, bracket close, right, to the square. Is it clear? Now this is which way standard deviation? We called as which standard deviation? Daily standard deviation, right? We can calculate standard deviation with this one. Now same daily standard deviation, what we need to do?
Annualized.
Can we calculate annualized standard deviation from daily? Now, when we are doing in Excel, okay, first we'll do the concept clear, then I'll go to the Excel, right? What? How do we do annualized standard deviation in Excel here? Okay, I'll add here. Okay, let's see. Annualized standard deviation. We have company called what? Facebook. Standard deviation of Facebook, but we are talking about which standard deviation? Annual standard deviation is equal to standard deviation of Facebook, right? But which standard deviation? This is daily standard deviation into square root of how much trading days into square root of how many trading days?
250.
250 trading days, right? So let's say for example, if daily standard deviation of Facebook is, let's say, 0.9, then into what we should do? Root of how much?
250.
250. So we can say annual standard deviation of Facebook is nothing but zero point 0.9 into what is the square root of 250?
15.81.
15.81. So
Yeah.
it's nothing but annual standard deviation. So what is the value together?
14.23.
So standard deviation, annual standard deviation of Facebook will be how much? Somewhere close to 14 point. How much, sir?
23.
23. Is it clear? Am I clear with what is annual standard deviation? How do we do in Excel?
Yes.
Yes, sir.
Now you can ask one question to me: why we need to do square root? And specifically 250 days trading days. Why we need to do square root of 250? Again, there is a logic. Shall I? Shall I
Yeah.
proceed next one?
Yeah.
Yeah. Let's see why we need to do the square root. So question is why square root? Okay. Why square root with 250? This is the question, right? Now let's see. All of you please see here. Standard deviation is equal to root of variance. Is it clear?
Correct.
Yeah. So it means what? This can be also written like this. It's a root of variance into some time,
Yeah.
right? So
Yes.
it means what? Root of variance into time is equal to root of variance into root of time, right? So what is this formula?
Yes,
This
sir.
has two components, right? One component is of variance and one component is what? Time, right?
Yeah.
Right? So what we are doing here exactly from this, I'll go to the next page. So the formula was like this: root of variance into root of time is nothing but Root of variance into root of time is nothing but standard deviation is nothing but into, when I remove this one root, it will become what?
Just standard deviation.
Just standard deviation, right? Into root of time is nothing but root of t. Is it clear?
Yeah.
So it means what we are doing, this is my daily standard deviation into square root of what? T. That is why we need to consider the square root of into t. Is the logic is clear?
Okay.
Everyone understood why we need to do square root with 250?
Yeah.
So shall we go to the Excel sheet now?
Yeah.
Please come to the Excel sheet, all of you. This was- Okay, now let me add here columns. So shall we calculate now? Write down here standard deviation. But we are calculating first standard deviation of what? We'll first calculate daily standard deviation. Did you open Excel, everyone? Okay. So let's see. What will apply the formula is equal to STD of S. Now we are calculating standard deviation but daily. So shall we?
Yeah.
Now what we should select here? Which column I should select to calculate standard deviation of Facebook is nothing but returns. Select this column, entire column, Control D. You got this one? Is it clear?
So can you just show this standard deviation daily again?
Is it visible, ma'am?
Yes, sir.
Okay. Now what we'll do? Daily standard deviation will convert into
Yearly.
yearly. So we'll write here standard deviation bracket annual. So what we'll do? Daily standard deviation. Just now we discussed formula, right? Into what I should type here next one?
SQRT.
SQRT square root of, we will take how many? I think previously also we took 250 days only.
Correct.
So we'll take this one. Now we convert this daily standard deviation. We converted into annual. Both will convert into percentage. Two decimals. So somewhere close to how much? Daily is 2.34 and annual is 36.97. All of you getting the same answer?
Yes.
Please calculate others also.
Sir,
Also,
I got
Does-
this, but I have a different query. Since we
Yeah.
have taken daily price, so we
Mhm.
got daily returns, daily standard deviation, right?
Yes.
And we multiplied it with for annualized with the trading days 250 and your square root of 250
Correct.
multiplied.
Correct.
Suppose if we take monthly
Mm-hmm.
or yearly,
Mm-hmm.
then so when we take monthly, so we get monthly annual returns. So we
Correct.
multiply it by 12, right, to get annualized return.
Mm-hmm.
That is what my query is.
Yeah. Yeah. So what is the monthly returns of your stock? Average monthly returns converted
Hmm.
into annual returns. But
So
here,
we need to multiply it by 12.
yeah, actually, ma'am, yeah, correct. If it is week means you can take with 50 for 2 weeks based on number of weeks how much the trading is.
And sir, if it is like your same, the standard aviation daily which we have got, and for
Mhm.
annualized we have taken square root of 250. So there we
Mhm.
will take square root of 12 and square root of 52.
Yes, it's a time of that, right?
So time is 12, right? And
Correct,
for
correct,
52 for the weeks.
correct.
Okay.
Yes. Shall we proceed with the next one? Now, how do we calculate this one in manually? If I want to calculate this one as manually here, okay, please add two more columns here. Added. Shall we? Okay, so let's add one more. How do we do it manually? Let's say if I want to go with the as per the formula wise, so how do we calculate r minus bracket open expected r, right? So r minus expected r is nothing but what? This will become what? R means your actual
Deviation.
return, r means expected return. It's a deviation, right? So let's see, we'll commit here manual approach. So my ER, expected return of a stock, is 0.13, and then we'll take SSD, okay, sum of square deviation, then we'll take variance. Please write down this one. You can type this one, then we'll calculate what? Standard deviation. Okay, now let's calculate this one. So first what we'll do, we'll calculate the deviation. So what is the deviation? Basically exactly equal to actual return minus what is my expected return, 0.13. Can we lock it this one? Yes or no? Shall we calculate deviation between actual return and expected return? What is the deviation?
C,
11.2.
C minus D also we can do it. The D column is also expected return.
Yeah, yeah, these two also you can do. Yeah, that also we can get. So what shall I do? Drag it down. So we got deviation, right? Now what we'll do now? We'll calculate next column, that is your R minus E Now this deviation should be square, right? So square means r minus expected return. We'll do square of this deviations. So what will be the formula now here? This deviation need to square. So is equal to, take this value, the first deviation value. Square means you can put hat of how much? 2. So did you got this answer? So we can just drag it down. So we got the square deviation. So what we call this as what? So I'll put it here. So what is SSD? SSD is nothing but what? Sum of square deviation. So
Deviation.
can we take sum of this? So
Yes.
is, let us calculate, is equal to sum of all this deviation.
Yeah.
Select this, control shift down, close the bracket. So what is the value we got?
That's right. 700.
0.770. Now sum of square deviation need to calculate variance, right? So now what we'll do? We'll take the variance. So how to calculate variance now for this? Okay, let us write down the formula. Is equal to, now what is variance here? What will be the variance? Sum of square deviation, this value, right? Divided by
N minus 1.
n minus 1, right? As we discussed the theory formula, right? So how do we calculate n minus 1? Can we apply count function here? Count of, what we'll take now? We'll take the values of your returns. So that is from your C6. So this is your C6, or we can say C3 here. These two, control shift down. Then what we'll do? Bracket close. N minus how much?
1.
N minus 1, right? Again bracket close. You will get this value. Everyone got this? So what is variance? Variance is nothing but what? Your square deviation into 1 divided by n minus 1. So now can we calculate standard deviation?
Yeah.
So what is standard deviation now? Is equal to square root
Square.
of variance is what? Square root of variance is nothing but standard deviation.
Correct.
Close the bracket. You will get this value. But standard deviation should be in
First.
percentage. So we'll convert this into percentage. We'll get same answer. Are we getting the same answer? 2.34.
Sir, sir, what
Yeah.
exactly variance indicates?
Variance.
This
Variance.
variance, what
Var-
does it indicate actually?
Variance is nothing but how far the value is varying from your mean value.
Okay.
Are
So
we getting the
then,
same?
so
Yeah.
then what standard deviation would indicate? It would also indicate the same, right?
But it's a deviation. Now again here we have to see the normal distribution approach here. What is standard deviation here tells your stock may increase or decrease with plus or minus 2.34. There can be a deviations. It means if the stock rises, your return may increase with 2.34 or it can decrease with 2.34 deviation. With how much percentage? Are you getting, ma'am?
Yes, sir.
Actually, many formulas, like one of the formula is like your Garsh and Arch model. It is developed on variance, not on standard deviation. It's just an will tell you in the normal distribution curve. If we put into the parameter like 2 deviation, 3 deviation, 3 there is a level of deviation, plus or minus how much it will vary your stock, means how much it can increase or decrease. Shall you go to the next approach?
Yes.
So we got the two things we done to the calculation. One is your returns we calculated, and one is your risk is calculated. So now we'll proceed with the next concept of what is basically we can say market risk concept. We'll discuss here. How do we derive the market risk? Okay, that concept we'll discuss now. Okay, so let's proceed with. Shall I go to the my slide here? We'll discuss next concept.
Yes.
Okay. Next one concept is your estimating the market risk of a stock. Okay. In this, first we'll discuss what is market risk. Nothing but how much the stock is impacted by the market. How much my stock is impacted by the market. Because of market, how much the stock is impacted, that's because of market risk. Let's say, for example, if you want to discuss how much the Amazon share price is impacted by the S&P, or because of recession, or because of boom, or because of inflation, and so on. Because these are the things which are uncontrollable, right? So how much Amazon share price is impacted by the S&P, or it's because of the recessions, or it's because of the any phases of economy or inflation, that will hit on your stock return. That's because of the market risk, right? Now, what our CAPM model says, okay, what CAPM model says that expected return, according to CAPM, the expected return of a stock is only impacted by the market. The expected return of a stock is only impacted of because of what? Market. So that's why we write the formula. Expected return of a stock is nothing but RF plus beta J into expected return on RM minus RF. So here beta, which talks about which risk? Systematic, which is once again expression to which risk? Here your beta, we talk about systematic risk, and this is your expression to which risk? Market risk, right? Now, how do we measure this market risk? We should have some tools, right, to measure market risk. So the next concept comes measuring market risk of a stock. So what is the tool? The beta is, or we can say the beta displays the relationship between the stock and the market relative to overall risk, right? So when we say risk, it's nothing but your volatility, and volatility is nothing but measured through what? Variance. It comes from your variance. So when we say variance, we can calculate two variance. First one is something called which variance? Stock variance. And second one is we can calculate two variance. One is stock variance and the second one is something called as what? Market variance, right? So variance of a stock and variance of market, right? Is it clear? Shall we discuss now how to calculate stock variance?
Yeah.
First, let us see how to calculate stock variance. So your stock variance is nothing but sigma j. Sigma square is nothing but your variance of stock is equal to 1 divided by n minus 1 to the summation of n to the time 1 rj return of stock minus expected return of rj square. This is which variance? Is it clear this formula?
Yes, sir.
This is your stock variance, right? The next one is something called market variance. So we should know also something called as market variance. So what is market variance? Instead of J, what I can write here? Everything will remain same, but what will change? The notation will change. So what will come here? When we say variance means sigma square, sigma square of what? M. What is M stands here?
Market.
Market. So sigma square of M is nothing but, again we need to have unbiased estimated of true variance is 1 divided by n minus 1 to the summation of, again same parameter, n to the time of 1, open the bracket, right? Right now. Instead of Rj, what will come? Rm. Rm means return of market minus E of Rm. Rm means expected return on market, bracket close. What will become? Square. So this is becomes which variance now?
Market.
Market variance. So we have two types of variance, stock variance and market variance. Now, relationship between these two. Now, relationship between these two, one is stock variance and one is market variance. So two variance, but of different, right? Two assets, right?
Yes.
One is stock, one is what? Market, right? So variance, what it will become? So it will be a, can I calculate covariance of between stock and market now?
Yes.
So it means ultimately I'm trying to build the relationship between what? One is between what? Stock, and one is
Yes.
between what?
Market and stock.
Market. So there is a relationship between stock and market. That relationship I can measure with the help of covariance, and also I can measure with the help of correlation. So it means if I have stock and if I have market variance, I can calculate covariance. I can also calculate
Correlation.
correlation. Is it possible or not?
Yes.
Right? So it means, so to calculate covariance correlation, you should have variance among the stock and market, right? Between these two, what is the variance? So now let's see formula. Let's see first one, which defines your, what is the first one we can calculate?
Variance.
Covariance. So it's a variance between what? Stock and market, right? So we can say covariance of RJ. What is RJ here? Stock. And covariance between stock and what? Market. Yes or no? So covariance between RJ and RM can be rewritten like this: 1 divided by n minus 1 to the summation of n t is equal to 1. Now it's a covariance between two assets. One is stock and one is market. So we can say RJ minus expected return on what? RJ. Again, this is stock over. What is the next one? Market. So we can say RM minus expected return on what? RM, right? So what is this? How many assets we have? Two assets.
Two assets.
So between two assets, what is the covariance? It's nothing but variance covariance divided by n minus 1, right? So it means it's a covariance between these two assets, right? So how do we measure this one? From there, the concept of beta will come. So beta we can write as Bj is nothing but, okay, covariance. It's a covariance between what? Rj and what? Rm. So this one is Rj, this one is what? Rm. So covariance between stock and market divided by variance of what? Rm. So that is how our CAPM, when we write the formula, RF plus beta. So beta measures the sensitivity between your stock and market with relationship to the market, right? So this also can be written as sigma Rj comma Rm divided by sigma square of Rm, right? So now tell me, in finance, many time beta of market is how much? Now I'm talking about beta of market is always
One.
equal to how much?
One.
1. But the question is, how did you got this 1? Correct? No?
Yes.
Against this market, I'm measuring my which beta? Against market, what is my stock beta? Nothing but sensitivity, right? So we say beta of market is always 1. Why? Let's see. Right? So first we should know what is the beta of market then. Correct, right? So how do we calculate? Okay, let me write here. Let's see here. Is it the screen is visible here?
Yeah, it is.
Okay. Now, beta of j is nothing but 1 divided by n minus 1, okay, to the summation of, first we'll say stock, okay, first we'll write down stock n to the power of 2 is equal to 1, rj minus expected return of rj, again rm minus expected return of rm divided by 1 divided by n minus 1 to the summation of t is equal to 1 n rm minus expected return of what, rm to the square, right? This is beta of any asset. Beta we can calculate like this, right? Now further I am writing here bm, beta of market is equal to 1 divided by n minus 1 to the summation of n t is equal to 1. So we say beta of market is nothing but rm minus expected return on rm, bracket close, again rm minus expected return on rm, right, divided by 1 divided by n minus 1 to the summation of t is equal to 1 n. So we say rm minus expected return on rm square. So this will become beta of what?
Market.
This is beta of market now, because covariance of market divided by variance of market. This upper is called as covariance, below is called as what? Variance, right? Shall I proceed next one? We have to substitute this formula.
Yeah.
Okay. Now beta of market is equal to 1 by n minus 1 to the summation of n t is equal to 1. Now here what I will do now for calculation purpose, Rm numerator value Rm minus, now how many times we have ERM and ERM, can I do square of those,
Hmm.
this one and this one, what it will become,
Square.
it will become square. So I can write as Rm minus what, expected return of what, Rm square, is it correct,
Yes.
divided by what happened, the numerator just variance will become square variance, right? So again 1 divided by n minus 1 to the summation of n. Now what is the denominator here? Same value,
Same.
Rm minus what? Expected return of Rm, bracket close, to the square only,
Correct.
correct? So it means it can be written, the numerator can be written, can I write like this, square of what? Rm divided by, this also can be written like this, square of what? Rm. Is it correct?
Yeah.
So variance of market divided by variance of market. So any variance itself divided by itself, it will become how much?
1.
So it means beta of m is always equal to how much? What is the beta of market? Is always equal to? Is it clear?
Yes.
Others able to follow this one? Little bit mathemat. That's why I told in the beginning. CAPM and other these models are purely based on maths and logic, right?
Yeah.
How do we derive this formula? Because we taught in the classroom beta of market should be always taken one, but there is a logic behind this one, right? Is it understandable what we derived this formula?
Yes, sir. Yes, sir.
Now we need to interpret this beta, right? So how do we interpret this beta? If beta of j means what? I'm referring j means
Stock.
stock. If beta of j is less than beta of m, beta of m means market, then stock beta is less than market beta, then what happens to stock? Is stock is less risky or more risky? Beta of stock is less than market. So it let's say zero
Yes.
point 0.8 is less than 1. How much stock is
Less risky.
less risky? Now let's imagine it can be reverse also. Beta of j is greater than beta of m. Then what happens now? Let's say 1.2 is greater than 1. Stock is
More risky.
more risky, right? Last one. Beta of j is equal to beta of m. 1 is equal to 1. Then what we say? Stock is as risky as market. Am I clear this concept?
Yeah.
Right? So now, shall we proceed with our calculation? Now I hope we understood all the theory behind this one.
Yeah.
So yesterday I sent one data set. Remember, two stocks are there in that Apple and S&P.
Correct.
Yeah. So now is the theory is clear? Stock variance, market variance, then covariance, correlation, beta of market is clear.
Yeah.
Beta interpretation is also clear.
Yeah.
So shall we go to that Excel sheet now?
Yeah.
Okay. So I hope you have this Excel sheet with you. Okay. Once if you're ready, please let me know so that we can start this calculation.
Yeah. We are ready.
So shall we work on this one? So what is the first step
Yes.
we should do? We should calculate the returns.
Returns.
Okay. So all of you, can you please calculate returns of individual? Now, first of all, let us try to understand. Just one second. Yeah, market. Which is stock here? Google is stock. S&P 500 is a, it is called as
Index.
what?
Market.
Index. It is an index. So we'll treat this as market, right?
Yes.
So all of you please calculate. Now we have one stock and one market is there. So stock is Y variable and SNP is your X variable, right? So Google returns are depend on S&P 500. As of now, we'll assume that concept here. Okay. So we'll prepare certain columns here, and according to that, we'll start taking this. Okay. So first thing, what we'll do, we'll write like this: R underscore Google. R underscore Google means return of Google. So we'll write as an R underscore SP 500. Then first we'll do this to calculation. Okay. So I'll not do first day calculation. We know, right? First day returns will be always 0. So can we calculate returns here? Is
Yes.
equal to today's value. We'll take first Google this value. Today's value divided by yesterday's value minus 1. So we got this value. You can double click on that one. So can we double click? Do we got all the days written? Now let's calculate market returns is equal to today's value divided by yesterday's value minus 1. So we got S&P 500 returns. Double click on this one. You get all the returns. Is it clear?
Yeah.
Okay. Now, next thing is what we should calculate. We'll go further columns making. Column will we keep on adding over here. Okay. So first what we'll do, can we calculate deviation now? Deviation between what? Stock. Then deviation between market. So what we can put here, we can open the bracket here. R underscore Google, okay, minus, what is the formula? Return of Google minus expected return of Google, right?
Hmm.
R underscore Google, right? So can you please calculate this one? Deviation. So this is my deviation. So how do we calculate deviation? Any idea? Hmm?
Average return need to be calculated. Daily average return.
Yeah. So it means what? So we'll calculate deviation here. So let's take here deviation between these markets. So first we'll calculate here is equal to this value minus what? Average value,
Average.
right?
Hmm.
Average of, again, from this value to this value, right?
Hmm.
So it means average is fixed, right? So can I lock this cell?
Yeah.
So I lock it this one. Function F4 you can place here. So it means daily return minus expected return. Done. So can we enter? So this is your deviation. So double click, we'll get all the days deviation, right? What is the next thing we should calculate?
The
Deviation of,
square of the deviation.
what we'll do, sir, here, we'll finish the deviation, then we'll do square. Shall we?
Yeah.
Okay.
So now we'll do deviation between market now. So what we'll do, R underscore SP 500 minus E, open the bracket, R underscore SP. Okay, I'll just close this one, double click. So again here also we'll calculate this one deviation only. So is equal to, what we'll do now, again same logic will apply, this value minus average of from this to down, close the bracket. But what we need to do, we should
Freeze.
freeze this cell. So we'll freeze it. So we got deviation of market. Just double click on that one. Oh, my, it is kind of like this. Is equal to this value minus average. Okay, there's something wrong with me.
You can copy and paste also.
I don't know why it's happening. Actually, I've written correct formula only, but it's freezing time.
No, you're supposed to take it. No, correct, correct,
It's correct, right, sir?
correct, correct, correct.
But yeah, now it came. Yeah,
Double click. Yeah.
that option was not showing. I was worried about that.
Yes.
Okay, so let's see the next one. What is the next possibility of column here?
Square of that also we can do
Square
it.
of, we can do square of this also, both market as well as Google. So what I will do, this is the square of Google. We can say, we can write here square of Google. So square of Google, and then we have square of
Market.
market. I'll write, instead of market is SP 500. So we'll do square. So let's see. So what is the square of deviation means? So is equal to this value. We should square. So we got deviation square of Google. Double click. Then again we can calculate square of deviation, that is this value square. So we got this value also, right? Is it over?
Yeah. Yeah.
Okay. So now what is the next column we can calculate? Covariance, can we calculate covariance? Covariance between whom?
Google and S&P
Google
500.
and S&P 500. So what we'll do, we'll take covariance, open the bracket, R underscore Google minus expected return of r underscore Google should be multiplied with r underscore m minus
Minus R underscore
m bracket
expect.
open expected return of r
Yeah.
rm, right? Is it clear?
Yeah.
So let's see what we can do calculation here. Okay, so shall we, how to do this column?
Multiply these
Multiplying the both
square.
square, we can multiply square of r minus Google expected return into r. So can we multiply these two column? So is equal to this value, like one second, not this value, this value, right? R minus expected return of Google, right?
Yes.
Into R minus this two value, correct?
Deviation.
Deviation, yeah. Did you got this answer? Is it clear?
Yeah.
So what we'll do now, double click, you'll get all the multiplication of deviation of stock versus multiplication of deviation with market. Is it clear? What will be the next one more column? Variance of market, right? So it means R underscore M minus E, open the bracket, R underscore M bracket close, to the square of 2, right? So it means I'm taking variance of market. So shall we? So how to calculate that column? Is equal to RM minus ERM, right? So what is the RM minus ERM? RM minus ERM square. So it means this value square, right? Return of market minus expected return of market, square of this value. Is it?
Yeah.
So I think we'll get this value. Variance of market, correct? So what we'll do now, just double click on this. So this
So
is
you
the,
have done it already. The square of SP 500, that is deviation square which you
uh,
have done is the same, na?
yeah, it's the same only. Yeah, yeah. Correct, ma'am. It's the same
Already
only.
it is being done.
Yes, 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 ma'am. Correct. We have value here, right? This only same values.
Yeah. Square.
Square. Okay, so I think we got all the values here. Now we'll prepare one workings here. First, what we'll do, we'll write covariance. Okay, then variance, right? Then we can say beta of what?
Google.
Beta of Google we have to calculate. So that is the approach. So let's start with the calculation of this. I prepared box here, a small box you can prepare there. Okay. So first thing is we need to calculate covariance, right? Shall we start? Do you
Yeah.
prepare this? So let's see. So what we'll type here is equal to sum of, open the bracket. So it's a covariance, right? Sum of between whom? Google and market, correct? This value, sum of covariance between these two, bracket close, divided by 1 divided by n minus 1, right? Open the bracket. This one divided by, open the bracket, count of, again open the bracket, from this value to this value count, that is n, bracket close, minus 1, because n minus 1 we are taking, again bracket close, enter. So what is the covariance? Is it got everyone covariance? Shall I repeat the formula?
So this, I just want one doubt.
Yeah, yeah.
So this is daily covariance, no?
Yeah, it's a daily covariance of the
Okay.
stock and market.
That I understand. So if you want to do it for example, like annual, so then we have to multiply it by 252.
Yes. Now it is a overall variance between your stock and market, right? It's a taken from the sum of all, taken with the market and stock both.
That I understood. My point is that the value is in exponents.
Exponents. Yeah.
For
So you
example,
can do
yeah,
the multiply with
it's a very
yearly
small. Yearly we have to convert it out because when we calculate in portfolio, so I think it should be converted in yearly base.
yes, yes.
Yeah, thank you. Okay.
What is the next one we have?
Variance.
Shall
Hence,
we calculate variance now? So
So
again
can you
we,
please show this covariance again?
I'll double click on this.
Yeah.
It's a sum of RG minus expected return into RM minus expected return. Okay, divided by count of, overall count means total n minus 1. Got it?
Yes, sir.
So can we calculate variance now? Variance of what?
stock as well as index.
Okay, so covariance is between stock and market, then divided by variance of what? we are actually calculating beta, right? So for beta formula divided by what? Variance of m, right?
Correct.
So we have to take variance of market, right? So let us see now. Please let us do together. Sum of, okay, open the bracket. Now let's take this value, variance, right? Variance of market, RM minus ERM square, right?
Hmm.
Sum of, take from the beginning till end, take overall values, close the bracket, then divided by, again what we should do?
Count.
Count n minus how much?
One.
1. So it means it's a count of between this value to down minus 1, again close the bracket, enter. You got the variance? Yes or no?
Yes.
So now what is basically others, did you got the variance? Shall you proceed or shall I show you the formula?
Yes, sir, we can proceed.
Okay. So now we got variance and covariance both. Remember, just let me open my slide. Here I think I have discussed, right.
Covariance divided by variance of the market.
Here I think this is the, here this is the slide. Can you see the slide?
Yeah.
Beta of stock is nothing but covariance of RJ comma RM, that is nothing but covariance between market and stock divided by variance of market, right? So now we'll go back to our Excel sheet. What we'll do, can I take this value divided by how much? Covariance
Variance.
divided by
Variance of
variance.
market.
So what is the beta?
1.03.
0.03. Please divide this one and calculate, everyone. Over, everyone.
Yeah.
So I'll do this one once again. This is called which approach? Manual approach. Correct? Can we do with functional approach? What is the difference between
Yes,
manual and a function? We should get answer same only, right? In both the approach, we should get same answer. Manual means we are individually we are calculating and we are checking the answer. In functional approach, we have some syntax for calculation of covariance and variance. Am I correct?
yes, sir.
So can we
Yes.
calculate instead of doing so many steps? Can we replace that steps with, let's do with functional. Let us calculate is equal to COVAR. Okay, open the bracket. Covariance. Now let us see what is the covariance we should take here. It is asking array 1, first variable. Covariance between what? What is your value? First variable, which one we should take? Can anybody?
So market.
Any
Market.
variable.
Any of the variable you can take,
Any
right?
variable.
Any variable you can take. Need not to be market also. Okay. So let's take, it's a covariance between market. Please take all of you. So covariance of market. So what is the
Return,
value?
return of the market, right? Market
Return
return.
of the market, right? So shall I take Google first? I'll take here. Okay. this one, comma, what is the next one? This one, correct? Close the bracket and hit enter. Do we got the same answer almost?
Yeah.
Now what is the next approach?
Variance of the market.
Variance of the market. So let's calculate. How do we calculate variance? Is equal to var, open the bracket. Now what is the variance of market here? So what is the variance of market? Which value we should take here?
Google. Sorry,
What is
S&P.
the market here? Market stands for which one? Google
S&P.
or S&P?
S&P 500.
S&P 500. So we should take variance of this, right? We got this answer. Now what we should do? Anyone?
What is the formula
Value
once again?
divided by
V
variance.
var, right?
Yes, sir. Var.
Okay.
So can I divide this to this
Yes, sir.
value divided by this value? Almost near to the answer.
Yeah.
Am I correct?
Yeah.
Some difference 0.299. It's nothing but equal to zero point 0.3, right? Beta using which function?
Slope.
Slope. Even
Slope.
this is also one way of calculating beta. So let's say is equal to slope, type the formula, is equal to slope, open the bracket. Now tell me, first what it asking? Known
Y.
y. Y is a dependent variable, x is independent. What is y? Market or
Market.
stock?
Stock return.
Oh,
Stock return is the dependent, right? So we'll take Google's this one, this to this. Press comma. Now what is popping up? You're highlighting known x. So x is market now. We'll take it x market. Bracket close. Enter. Did you got the same answer?
Yeah.
So now, are you able to get the same answer? Both the way. This is called manual and functional approach of calculating variance covariance. So now you tell me, this beta, is it more than 1 or less than 1?
Almost equals to 1.
Almost equal to. It's 1. If I take, for example, 2 decimal, then it is 1.03, right?
Okay.
So it means if I say 1 and 1, just slightly little bit more than 1, right?
Yeah.
Slightly, but not that much. We can say almost equal to 1. If I remove the decimal, then it is equal to 1. But if I take point, because that is also variation, right? So it means it's just little bit greater than 1. Still, I'll take it as little bit more than 1. Okay. So now tell me, 1.03 is greater than 1. If I reduce the decimal, I'll reduce the decimal here and I'll keep it 2 digit. So it is how much now? 1.03, which is greater than 1. So now tell me, just now we discussed interpretation of beta, right?
Yeah.
So now you tell me, beta, I think this is second category, right?
Yes.
Bj is greater than bm.
Hmm.
So bj is greater than bm means stock is,
Little risky.
yeah. So we can say, well, let's come to this one. Stock is risky, but in our category it comes under what we have written, it is under more risky, but we can't say more, in the sense it's not that risky, but it's close to the market risk. but it's little risky, we can say. Is it correct?
Yes, sir.
So that's the beta of any stock. That's how we calculate. So this is was two approach we discussed. One is manually. We can manually means in the classroom we do in board calculation, but Excel has that features of doing everything with the help of some syntax called as covariance formula and variance. Just divide these two, you will get the beta value. Okay, everyone got this concept now? Everyone able to understand how do we got this beta? Okay.
Yes.
Yeah.